Stocks are screaming higher as the year ends. Will it continue in the new year? To find out, today we're talking with Andrew Krei of Crescent Advisors. Andrew, welcome.
Thanks, glad to be here.
So the Fed has indicated to the market that there may be 3 rate cuts next year. How do you see that affecting the market, and do you think the market believes them?
The market actually thinks that they're going to have to do more than 3 rate cuts. So at this point, based on the recent communications we've seen out of the Fed, they started to move incrementally in the direction of suggesting they will be more accommodative. They think the rate hike cycle is for sure over. Now it's a function of how much are they going to cut into next year. So market is saying more like 5 to 6 times. If you look at kind of the implied pricing, which is really a function of kind of what we're seeing, the soft landing, right? This idea that we've got slowing inflation towards the Fed's 2% target. We've seen growth hold up at reasonable levels. I think at this point, kind of consensus estimates are in the mid 1% range on a real growth basis. Nominal growth, GDP being somewhere in the 3 to 4% range. And we're seeing a labor market that's still fairly healthy. So all those things would point to a soft landing, which would allow the Fed to start to bring down rates incrementally. And again, I think the market is effectively suggesting that they can be a little bit more aggressive on their rate cutting, perhaps than even the Fed is suggesting that they will be, because all these conditions are pointing towards a soft landing.
So what does that mean for portfolios? Is this the time to be doubling down on stocks if you've got them? Is it time to be a little more defensive? How do you see this playing out in early 2024?
Risk markets in general love a Goldilocks scenario, right? Where you have inflation coming down, but not coming down too quickly, certainly not running too hot anymore. At this point, I think we can generally agree on that fact. And growth is neither too slow nor is it too hot to really concern the Fed. So if you get that just right mix of those 2 factors, that's a great environment for risk assets historically. Now, the question becomes, are we getting a little bit off sides with how far we've run up now in the last couple of months, and certainly around the Fed's communication that they're pivoting towards a more dovish posture? We think that rubber band could get stretched a little too far, and there would be some scope for a pullback or at least a reset at some level. But by and large, we think it's a favorable backdrop for risk assets going into 2024, by and large. I think maybe some of the things we would point to in terms of the composition of returns next year would be, let's look at small cap stocks. And one of the big laggards this year relative to large caps, in particular large cap tech, the Magnificent Seven, everybody's been so fixated on those names that have done so well this year. Is there a chance that we see a little bit of a catch-up trade from small caps? We've already seen that in recent sessions here, sort of post-Fed commentary. Small caps have done really well in this environment. They've underperformed dramatically. And even if you want to take the S&P 500 on a capitalization weighted basis, which has these really big weightings to those big tech names we've talked about, relative to an equal weighted basis, we're seeing a little bit of a catch up now, even in a couple sessions there. We think there's scope for some of those, so the others that have been left behind in the market to do well going into next year as people rotate out of the safety, perceived safety at least, of those Magnificent Seven tech names.
So talking sectors specifically, what do you like right now? What do you think looks attractive?
We would probably be a little bit more cautious around tech, and particularly, again, mega cap tech that's done so well. And not to say that those stocks will do poorly next year. There's certainly the operating performance of those companies seems to be very resilient and solid. But I think it's more a relative valuation story as much as anything for us, looking at some of the less loved sectors this year. So even things in the value realm, some cyclical sectors, financials, industrials, materials, those sorts of things that have been unloved now for some period of time. And we just think there's scope for a rotation trade that occurs there that sees some money flowing out of those things that have done so well, take the chips off the table, so to speak, and go into some things that have been unloved for some period of time.
If you are holding a lot of those, the Magnificent Seven stocks, is this the time to, do you think, start to drain those holdings, or just, if not adding to them, just stay put? Or would you actually advocate for actively rotating into something else?
If you've got concentration risk in that portion of your portfolio, if that's been a big part of what you've been doing with your equity allocation, take some chips off the table. And again, look at some things that have the potential to catch up, from a performance perspective going forward. So that's always going to be, kind of top of mind for us, is just thinking about the risk management, the blocking and tackling, portfolio management side of things. Again, not to say that those stocks are going to be poor performers, or that, again, there's real risk to their operating businesses. It's just more a function of where's the relative risk reward balance going forward into 2024. And we think it's probably more of a rotational kind of scenario than it is sticking with the winners from this year.
Okay, we will check back with you in a year and see how we did.
Very good.
We appreciate the insights.
Thank you.
Thanks for watching. Check out qz.com for more.